the nature of the limitations of my mobile phone, perhaps. It is Friday, July 7th, and oil prices on Brent are trading a little bit up, actually, 76 and nearly 77, and having a second positive week, a slow but incremental reaction, perhaps, to the recently announced cuts by Saudi Arabia and Russia. But nonetheless, it does seem like a market that's still struggling to break away from $75 a barrel on Brent, a little bit up, a little bit down, but ultimately in that spot. We're joined by our regular commentators, but spread across the world. I'm not even sure what flag Dr. Carol Nachtley, Chief Executive Officer at Crystal Energy, is sporting today. The last time I looked at the slide, I could have sworn it was Denmark, and now it looks like it's Poland. But either case, I'm in a taxi going to Heathrow. So we're all on the move. And I've been in Europe this week at the OPE meeting in Vienna, and then an interesting Oman FDI meeting in London yesterday. But Dr. Carol, I suppose the kickoff news of the morning is incredible bumper employment labor numbers out of the US yesterday, indicating further rate rises. Should the oil markets care that we're possibly going into even further tightening by the G7 central banks?
Good morning, Sean. Good morning, everyone. And I'm actually joining you from Warsaw in Poland. So yesterday when I saw the slide, was Oslo, it was Norway, and then Medellin changed it to Poland. Well, let's look at a little bit at oil markets from distance. So we know that there is a supply, and there's the demand side that are driving it. And on the demand side, one of the key factors has been the macroeconomic outlook, which has been to a large extent dictated by the rate policies, particularly in major economy, the largest economy in the world, that is the US. Now, everybody kind of celebrated when the Fed announced a pause to interest rate, but it wasn't just the data of the labor market that came out yesterday that signaled a higher interest rate, but perhaps to come. But also when you looked at the Federal Reserve's meeting notes, we could see that there is a strong appetite for a continuation of the rate hikes after a temporary pause. So that's what kind of dominated the market sentiment over the last few days. Add to that the data from China, another macroeconomic factor, where the service sector, yes, it grew, but not as expected. So it was rather disappointing because people were expecting a faster growth. And then so these are the two main factors on the demand side. And on the supply side, of course, we have the Saudi announcement of extending the cuts by another month, the Russian production also to be cut by a further 500,000 barrels a day. Also, Algeria, I think, announced some very tiny cuts. So these forces are acting together to drive the market today. But don't forget, there's also non-OPEC supply that people tend to forget about, with the US signaling or showing a higher growth for this year. So the rate on its own, the labor market on its own, is not the only driver, but it's definitely an important driver going forward.
Peter McGuire, XM Australia CEO. I'm taking some trend guidance from you over the holiday season here, Peter, sporting a beard. But I wanted to, Peter, get your views on the other big story of the week. Carol mentioned China. I'm not sure if it's migrating to be of relevance yet, but we saw the foreign minister of the US in China in the last month or so. And now we've got Janet Yellen, the Treasury Secretary in Beijing. It would appear both trying to patch up or somehow move the relationship from China, between China and the US, onto a more productive path. Your thoughts on that, on her visit and the relevance of it?
Well, Sean, and the beard suits you, so it's lovely to see you.
Yeah, you like that, huh?
Yeah, you look pretty sharp.
There's still a little black in there somewhere, but
we've got a bit of boot polish out. Look, there's no doubt that Janet Yellen, she's trying to create a piecemeal, and we're looking at that, and we're conscious of the fact of where China has been, and it's really languished since pretty much April. Their stock market's done okay, but it's certainly nothing like what we've seen in the likes of the Nikkei or of course, the US market. And she's there to try to appease the Biden administration moving forward to, I think, well, a bit of hand holding and probably a bit of handshaking. I'm not sure what she's going to actually achieve out of it, but I'm very conscious of a couple of things building on what Carol mentioned, as far as the services sector, as far as growth and where we're looking in the second half after we've seen an enormous first half as far as equities, and the US market and what the Fed's going to do. We're pretty much baked in now with a 25 basis point hike by 26th of July and another one later in the year, Sean.
Peter, do you think on that point, I mean, the Fed tightening cycle, it's obviously been dramatic over the last year, fastest rise, I think, in history. Yes. But yet it has had no impact on labor markets as of yet, certainly in the US, and very little impact on oil demand. Should we even care at this stage about these further rate rises from an oil markets point of view?
Well, I think it's going to have an impact because it will impact, I would say, demand somewhere along the line, Sean. There is no doubt when you're looking at that 2-year treasury, it's at a 16-year high. So there's the first part. It must have an impact as far as to the wallet and the purse, as you know, from an inflation story, from consumption. There's that part. So thankfully, to a consumer's point of viewpoint, oil prices at 70 or 75 bucks a barrel are far more affordable than 90 or 95. Now, if that was to change and we were to see higher prices, that would be, I think, a very, very heavy hand for Main Street to absorb. But, you know, I'm not sure how the second half play, but I'm pretty sure that you're going to see some excitement across US equities because it's been a jet-fueled rally for the NASDAQ, up 32% in the first half, the strongest first half since 1983, Sean. So it's absolutely flying. And then you've got the valuations are stretched and earnings growth is stagnant. So I'm just looking at what PEs are doing. There's 19 times earnings for the S&P. And that's expensive historically to think that you're going to be at another start of a bull market. So
apparently everybody hates this market rally because everybody's missed it, including oneself here. That it's sort of gone contrary to the general narrative of the whole first half of the year: recession, the wolf that never arrives. Let's go to Bill Spindle, global correspondent, senior correspondent with Cipher, which is a news agency focused on the climate story. Bill, as I said in my intro, I've just come from the OPEC, what they call the OPEC International Seminar in Vienna, which is a gathering not only of the OPEC ministers and the national oil companies, but also their counterparts from the international oil companies and other energy producing countries. So a lot of very, very senior representation, some element of the focus meant to be on what they called a sustainable energy transition. But there was a lot of talk about adding oil production, about the BP and Shell sort of backing away from their sort of commitments to back away from oil production and so forth. I'm wondering, from your perspective, can the oil producing community sector take this continuous path forward while adding renewables and this lower carbon portfolio, but ultimately not in any way backing away from oil?
Yeah, I think that is the big long-term challenge. You know, clearly oil demand is going to continue to grow at some level over the next 4 to 5 years. That's where the debate kind of starts about when it might peak. And there's a lot of disagreement about how much it's going to grow in that period. And then I think longer term, it's where do you see that peak coming? Is it going to be in the late part of this decade? Is it going to be in the middle of next decade? And how do you then respond to it? And that's where I think the oil industry is really trying to think that whole
It's
question.
interesting to see that the European oil majors now are taking the pathway of the US oil majors, which was essentially has always been to be, respectful of the energy transition, but ultimately ignore it. Can they get away with that, do you think, from sort of activist shareholders and so forth?
Well, I think one strategy I think going forward is going to be, continue to just focus on oil, but continue to return a higher percentage of of the money you bring in, your profits, to your shareholders, which is, I think, partly what we're seeing happening. I think Shell is now up to 40% or something, and that's basically less an admission that, oil's got a great future and there's going to be lots and lots and lots of it. And it's more an admission that they're not going to be the major leading players into the energy transition. So I think they will have to decide, do they want to pivot back to that? Do they want to try to build those new businesses? Or as this peak comes, whenever it may come, do they basically want to focus on, their knitting? And that's what the US oil majors have basically said, and try to make as much as they can off that. And then invest to the point they think is worthwhile, but actually return a lot of that money back to shareholders so they can invest it in some other way.
Carol, the other big sort of story I felt taking away from OPEC meeting this week, I wanted to get your views on, was the encouragement from the traditional OPEC members that to grow OPEC plus even further. There was a sort of any question marks that may emerge between the sort of, a media narrative, oh, Russia and Saudi are having problems with the relationship and so forth. No, it was the opposite. This OPEC plus is very, very firm, and they want to grow it, and they were encouraging whatever other countries were present or not present to join, and that the fact that together they can have obviously a greater weight and muscle on the international energy markets. Your thoughts on an ever-growing OPEC plus as a cohesive force and its relevance for energy markets going forward?
Before I answer that question, I want to go
Please.
back to what you mentioned earlier, Sean, about the wolf hasn't arrived. Well, if it's not about everybody being in a recession, it's about the growth rate, right? What the expectations were. And don't forget, many people were talking about a booming second half of the year and a tight market. This has not happened because we're talking about different speed. And if we did not have a slowdown in economic activity, or at least a growth which was not as expected, why are prices where they are today, despite the massive cuts that we have seen from OPEC? So we have to be careful here about the income effect of a recession. And there is also the other factor that affects demand that we call price effect. Demand responds to high prices, but with a time lag because of the elasticity. So that's what I wanted to highlight. In terms of
on that point, Carol, just to come back to it, one of the comments that were being made this week was the idea of, because that was a very big point, a big talking point in the meeting in Vienna, was why haven't markets reacted to these cuts? And one of the sort of more dominant answers was, well, this market reacts to show me, not tell me. So tell me you're going to cut, I'm not reacting, but show me the cuts, let me feel them, and the market will react. And the point there being that the market's not seeing or feeling, particularly the Russian cuts, but of course the Saudi cuts are only starting this month and continuing. What's your thoughts on that show me, don't tell me reaction of the market at the moment?
Well, show me, don't tell me about the Russian. I don't know whether we can see anything, because really data on
Right.
Russia more and more opaque. And I think we're all engaged in guesswork because we don't know where that oil is going and how it is going. So there's definitely some opacity around Russia. And Russia has a history of promising but not delivering. But the Gulf countries, including Saudi Arabia, and primarily Saudi Arabia, they deliver. But to go back to the point of beyond show me, not tell me, there is also non-OPEC supply coming to the market. And even within OPEC, if you look at Iran, for example, they are not doing that bad despite the sanctions. Actually, there is more oil coming to the market. So that's why I would find it very simplistic to only reduce the development to oil markets to just what OPEC has announced. Now, on the interesting question of growing OPEC,
Yes.
I was thinking about it, but I didn't have the chance yet because I was traveling yesterday to look at the top producers. But really, if you want to have a big influence on the oil market more than what you currently have, you want to bring on board the big producers. And who is the other really big producer who has the same might as Saudi Arabia and Russia? That is the US. Do you really think the US is going to join OPEC Plus? I don't think so. The other is, yes, you can grow, you can bring.
But on that point though, which was interesting, obviously the US government won't join OPEC Plus. But what does strike me increasingly, Carol, is the proximity that the international industry is in alignment with OPEC Plus. You know, the majors. At the OPEC meeting in Vienna, we had some of the biggest companies in the world and some of the smaller ones. So the international majors are sort of walking step in step with OPEC Plus, but in a parallel corridor. They all seem to have similar talking points. You know, we must invest in the future of oil supply in order to ensure that there isn't a massive price spike, etc. They're all sort of sharing the same talking points.
Of course, because they are all sharing the same benefit of higher prices. They want to be in business for a long time. Don't forget, what was the first cartel in the oil industry? It was the Seven Sisters cartel, the oil companies that we know today, the oil majors. They were the one who collided and tried to control supply to achieve certain price level. And their own governments also benefit. And I'm not talking also about just producing governments. I'm thinking about also the major consuming countries where they impose high taxes on the oil industry. So again, it's a very complicated scene that we cannot just pinpoint at OPEC what they are doing, what they are not doing. There's a whole chain of actors who benefit from that. Think of the windfall taxes that were introduced across Europe. In almost every single European country, a new windfall tax on energy companies was introduced to benefit from these high taxes. So I'm not surprised that the industry, the oil majors, the privately owned oil majors, the Exxons of this world, the BPs of this world, are singing the same song as OPEC because they all want to see they are in business for many years to come, many decades to come, because they are facing the same challenge. That is the energy transition. And you want to give your most valuable asset the longest shelf life, because renewable energy does not generate economic rent. Oil generates economic rent.
Peter, the narrative that we all were very exposed to in the first half of the year of two halves of such, all has been based on really where Asia goes in the second half, and in particularly China. Is the year of two halves still alive? Or is just take it that it's now like the dodo?
Well, it's a very hard one. I mean, I look at the equity markets and you've got to just be focused on them because of such huge demand and that fear of missing out, as you highlighted. And are we going to see that continuation for this quarter as far as move to the upside, or is there going to be consolidation, or are we going to see a sell-off? And that can change a global theme very, very quickly. So
does the equity markets tell us, obviously it's a future reference point to the economic outlook of profitability in 6 months or more. Are the equity markets telling us that 2024 is going to be a very profitable year for corporates? Or are these markets still drunk on the sort of irrational exuberance of 10 years of quantitative easing and not necessarily the outlook of profitability of major companies?
Yeah, I think that free money has driven, it's been dramatic what we've seen since 2010, 2011 move to the upside, that 12-year window. So yes, I'd have to say.
But even of the last few years, I mean, the COVID stimulus still filtering through to the markets.
Well, exactly. I mean, that's been dynamic in what we've seen as far as a recovery of that huge sell-off we saw in 20 or 21, I should say, and then all of a sudden, boom, and it's just continues to drive. And what we've seen in the last 5 or 6 months, everyone expected the first half of the year, as you highlighted, to be slow, if not recessionary, and that just hasn't materialized as yet. But with the Fed and central bankers continuing to raise rates, then I'm just sitting here going, well, it's got to have an impact somewhere to someone someday, and that may not be too far away, I think, Sean.
Bill, you're sitting in the land of tomorrow, supposedly, in the sense that the US is at the front end of this Fed rate hike cycle. And yet we're seeing yesterday massive job growth created in the US last month. Does it feel like there's any kind of economic slowdown in the United States? Certainly traveling around Europe this week feels like this is an economy that's thumping on all cylinders here. Restaurants are full, airports are jammed.
Yeah, things are going pretty well across the board, except when you look on the inflation front. We'll see. We have payroll numbers and employment numbers coming out here in a few hours. We'll see if they basically echo the numbers we got yesterday on employment. But if they come anything even remotely close to that, you're going to see, as we've talked about, another couple of 25 basis point rate hikes in the next good little future. And that means that the economy is sort of perched on the same place it's been.
I'm wondering now, actually, if Powell might do a Bank of England and shock with a 0.5% hike.
Let's look at the payroll numbers that come in next. I think later today. I mean,
yesterday was some pretty bumper numbers. 435,000, I think.
Yeah. It's all perched. It's perched on the same ledge it's been all along. Kind of the job market unbelievably holding up against this sort of onslaught of rate hikes. And again, we're looking at where does it go from there? We're off this teetering ledge. Does it fall off?
Is there any politics coming into it yet, Bill, in the U.S. with the presidential election cycle kicking off? Does that start to impact the policies that are chosen?
I don't think there's, a lot of politics overtly in it at this point, other than the usual ones that kind of go along with it. We're at the beginning of the election cycle. So I don't think that's a huge.
But we're seeing things like, the Biden administration being quite, touchy-feely friendly at the moment with Venezuela, stepping back from any sort of strict enforcement on Iran. I mean, the last few days there was some noise, but ultimately Iran is exporting as much oil as they can. On that side, it seems the U.S. government is trying to ensure that the oil price at the best as they can, and the oil price at the pump, which of course is the big one for U.S. election cycles. Let's go to the survey question today, which is again about this point of rate rises. Of course, they've dominated the landscape for the last year. But ultimately, they're not punching out employment, certainly, but they're having little impact on demand. And in that regard, the idea that, oh yes, not yet, but it will come, not yet, recession will come. I'm wondering if we have to start to see all of these things in parallel corridors, that somehow they're not crossing, intersecting. But I wanted to take the last segment here to give everybody a chance to give us their outlook for the months ahead. Of course, we're breaking for the summer on the podcast next week. So it's probably the last time we'll have Bill, Peter, and Carol on before September. So great to get your kind of slightly longer term views, what you'll be thinking about watching over the summer months, July and August. Carol, let's start with you. What do you think will be bigger factors for the energy markets to keep an eye on as you're lying on the beach?
Oh, I'm looking forward to that. I'll be actually running in the forest, in the Black Forest, no beaches there. But I would keep my eyes really on the macroeconomic indicators. That is for me the biggest factor, primarily in the US. in China because they are the two largest economies, and the EU because they are the largest economic bloc. So this is where I would watch closely, because I know everything else will adjust. I mean, it's easy to read in terms of, for example, non-OPEC supply or OPEC supply, what will happen next. But the macroeconomic, as you see from this podcast, Sean, there are so many variables, and you say, okay, this is happening, but the other is not happening. But in reality, in economics, especially when it comes to policy, whether monetary or fiscal, there is always a lagged effect. You know, so there's time difference between the announcement of a policy, its implementation, and the effect. It will take time for the effects to be visible, and that's where I will keep my focus on.
Peter, I know it's winter now in Australia, so you don't get to go to the beaches often, but what will July and August bring for Australia and for Asia, do you think? Did we lose Peter, or I can't hear?
Sorry, Sean.
Sorry.
I think what we've got to be conscious of from Australia is, do we see additional rate hikes over this winter period? There's the first part. Are we, and I won't be surprised to see that. What's the health going to be like in China and the likes of the Philippines from a demand picture? South Korea booming, Japan doing extremely well from an equity standpoint, and a low interest rate policy. So where are we seeing, I think, opportunity for trading with the yen, and what's happening with, again, I get back to that equity markets because it's very, very toppy, and maybe that some of that froth might get burnt off.
I mean, just to close out, Peter, you're speaking about rate hikes should be impacting, filtering through and impacting different things. But you would imagine that the front end of that list would be equities. I mean, equities, profitability, the cost of carrying debt, which of course all these publicly traded companies carry a lot of debt. The price of servicing that debt has, jumped dramatically in the last year. And yet, the equity markets are on the tear. Like the oil markets, should the equity markets care whether there's more rate hikes?
Well, I think they've got to care. There's no doubting that, Sean, as far as serviceability and bottom line. But the other thing is that it's just been such an AI-fueled jet stream of just, putting high octane gas in this that it's lifted all boats. And maybe it's going to run out of a little bit of juice over the next, couple of months. We've just got to sit here because what we've experienced this year has been nothing short of extraordinary. 40-year high. This is not usual stuff.
Bill Spindle, last word for you this morning as to where the summer focus should be. I mean, we are still on the pathway to COP28. Where do you see that narrative in terms of the world's coming together around a greater alignment on energy transition and the outlook of that balance between energy security and energy transition? It feels a lot like energy security is winning at the moment.
Yeah, I think that all brings us back to China. I kind of agree with Carol that the macro outlook is probably the most important thing going forward. The U.S. dynamic is pretty familiar. It's kind of the one we've been in all year. China, I think the big question is to what extent they're really battling some pretty structural headwinds there. And I think the question is, to what extent does China step up with a major stimulus plan or something that is more familiar as how they've dealt with these in the past, but would really make their structural problems even deeper in the long term, but could change the dynamics considerably in the short term. And then on the COP front, we're going to go through a period where there's going to be a lot of talk, as there have been the last few days, about whether fossil fuels need to be phased out and how fast they need to be phased out, and should the UAE be more forcefully pushing the idea of a fossil fuel phase out, despite the distaste for it in the oil and gas industry.
Bill, just a last comment. I know you spent quite a bit of time recently in Japan. What's the outlook there? I mean, ultimately, one of the world's biggest economies, the equity market, speaking of on a tear, they've been absolutely skyrocketing. The yen, of course, has taken a major devaluation over the last 18 months. How's Japan looking? How does it feel to you when you were there?
Yeah, I mean, it sort of feels like that equity run up has got to have a limit at some point, though we may not have reached it. It was really benefiting, I think, from the idea that there was a recession impending at any moment in the US, and a lot of money moved into Japan responding to that. The yen is reaching points that are pretty problematic in some ways to kind of the way Japan's economy works. So, but there's not much they can do about it, I don't think.
Well, they certainly have no interest in raising interest rates in Japan. And after multiple decades of sort of stagflation, I suppose they're happy to see a little bit of inflation. There's the poll result. We'll put it out on social, but ultimately disagreeing with the thesis, interest rates irrelevant for oil markets at this point. I don't know. It seems to me that you need to put into your, you know, that you can block certain websites or whatever. I think I need to block the word recession from my inbox, because ultimately it sort of fogs the mind to being the prism in which what looks at everything. A recession that's never coming is not really one that should dominate the headlines in a way that it has, I think. And maybe that's one thing to keep an eye on over the summer, is the removal of that prism in which everything should be studied. Carol Dackley, have a great summer. Thank you as always. You're awesome. Bill Spindle in New York. Take care, Bill. Look forward to seeing you back in Dubai after the summer holiday. And Peter McGuire, enjoy your winter. I hope you freeze your nads off down there, down under, as we enjoy some sunshine here in the Northern Hemisphere. All the best, everybody.
Thank
Have a
you.
great summer.
Thank you,
Thank
Sean.
you.
See you, Carol. See
All
you,
the
Bill.
best.
Catch you, man.